In this video, we're going to talk about put options and how you could use them to generate consistent passive income. If you're new to my channel, my name is Vijay. I've been trading options for over 7 years, and in these videos, I talk about investing in options passively and trading futures actively to ultimately help you become a better trader. If you want to join me on this journey, hit that like button, smash the subscribe, and let's jump into put options. So a put option is a financial contract that gives the buyer the right, but not the obligation, to sell 100 shares at a certain price on or before an expiration date. So this is from the buyer's perspective. Now, if you remember, every contract or every transaction has both the buyer and the seller side. So in this video, we're going to talk specifically about the seller. If the buyer gets the right, but not the obligation to sell 100 shares, that means the seller is actually obligated to buy 100 shares at a certain price on or before an expiration date. So why would someone willingly accept an obligation? Well, it's because the buyer actually pays something known as a premium. It's money to the seller, and the seller accepts this premium, and with that accepting, they are obligated to basically buy 100 shares at a predetermined price and at an expiration date. So let's look at a quick example. Let's say right now a stock is trading at $100 and you are bullish on this stock, as in you think the price is going to go up, but you think $100 is a little too much for this stock right now. So what you could do is normally put a limit order and maybe buy it at $95 or something like that. And so until the stock comes down to 95, you don't get to buy it and your cash is just sitting there. That's what a lot of people do, and I think that's a okay strategy, but this strategy is significantly better, and I'll show you why. Because if you put a limit order and if the price never comes to 95, the price of the stock could actually just shoot up to go higher like you thought it would, and you just don't get to participate. But what if you actually sold a contract that obligated you to buy the stock at $95? And that's what put selling does. Because if you remember, the put seller is actually obligated to buy 100 shares at a certain price on or before an expiration date. And so if you want to buy the stock at $95, you could actually sell a put option at $95 strike price, and you get to collect a giant premium. This is actual money that goes into your brokerage account. And basically, if the stock stays above $95, you get to keep this entire premium. But if the stock goes to $95 or lower, then you still get to keep this premium. But the only thing is now you are obligated to buy this stock at $95. So this is really cool because you wanted to buy the stock anyways at $95, but the only difference is now you got paid money just to wait for the price to come down. And if at expiration, and let's say the expiration is in 30 days, the stock is trading above $95, yeah, you don't necessarily get to own it, but you still got to keep this premium. That means your capital's freed up again to sell another put option at $95, or let's say the price actually did go up, you could actually sell it at maybe $98 and the stock could be trading at let's say $103 in this example. So you could actually just trail it up, and you're willing to just continually collect income, which could be as high as 40 or 50% based on certain securities or trading, and you get paid just to wait for the market to drop. So to do this, you must have enough capital to buy 100 shares of a certain stock or a security. So let's say a stock that you want to buy is trading at $50. With this strategy, you would need about $5,000 to do this. So of course, with any strategy, there are risks, and so it's very important that we understand this. The risk is price can continue dropping and a company could go bankrupt. You may be stuck holding on to a losing position, hoping the price will go up. So all this to say, there are risks because you're still buying the stock, and whatever happens to that company or the underlying could basically impact your portfolio aggressively. And especially because you have to buy 100 shares, these are probably larger positions in your portfolio based on how large your portfolio is. So the biggest thing is only sell put options on stocks you want to own for the long run. So as in, if the stock, continues going lower and lower, you should be okay holding that because your investment horizon is a few years or maybe up to 10 years, because eventually if you are bullish and you're right, the stock may go up and you'll break even. This is a fantastic strategy which actually outperforms during bear markets because of the fact you're collecting a premium. For example, you collected all this premium, and so if the stock continues going down, you're going to do better than someone who just used a limit buy order at $95, because now you have a premium to cushion your cost basis a little bit more, and that will improve your performance in the long run. Selling put options is one of my favorite strategies because I get to collect 20 to 30% semi-passively just to wait for the market to drop. And once it drops, I become obligated to buy all these incredible companies at prices that I wanted to buy it at anyways. The only difference is I got paid just to wait to buy it. You may be wondering, VJ, what can I do if I don't have enough money to buy 100 shares of a stock? Well, we actually put together a video to answer that exact question. Check it out right here.